Howdy, Team 42. It's your skipper here, Darius Dale, to present another episode of Proto Pro Live. I'm joined with the legend, our friend, Bob Elliot from over at Unlimited Funds. How you doing today, Bob?
Good, good. How are you doing, Darius?
I am fantastic, man. Thanks for making time, man. I'm a huge fan of your work, a huge fan of your frameworks, huge fan of what you guys are doing over at Unlimited. We'll definitely make some time to talk about some of the cool research that you guys are doing over there for allocators, towards the end of this presentation. But let's start the presentation with those people who may be sleeping under an incredibly comfortable rock. Give us a little bit of background of yourself and sort of how you came to be.
Yeah. I mean, my career has been a couple decades as a systematic macro investor. I was at Bridgewater Associates for almost 15 years and developed a whole range of strategies that were used in the flagship fund, and authored their regular newsletter, Daily Observations, and from there. I left about 5 years ago and kind of flipped to the other side in terms of figuring out a way to basically make hedge fund returns available for the masses at low cost, and that's what I've been focused on at Unlimited.
Yeah, that's awesome, man. You forgot something about your role at Bridgewater that I thought that really gravitates me towards you, which is you taught. I want to say that your analyst classes, I watch your Twitter, I watch your LinkedIn, and you, my friend, are one of the best educators out there when it comes to macro. There's a lot of thoughts on macro. We don't have to get into details. There's a lot of noise out there, but you help investors cut through the signal, cut to the signal through the noise, as well as anybody I've seen out there. So make sure you guys are following Bob on his Twitter and on his LinkedIn to the extent you're not doing already. You also said something that warms my heart as well, which is, partially why we started 42 Macro, which is, I don't think that the best of when it comes to institutional macro risk management needs to be confined to the hallowed halls of the buy side. I think you can find ways to package that and deliver those types of solutions and results to everyday investors like myself, or like the folks we grew up around and with. I think we both share a passion that this stuff doesn't necessarily need to be confined to a 2 and 20. Although I appreciate what you're doing out there, man, and happy to support.
Well, thank you so much. It's been quite an amazing evolution. I think when you and I both started our careers, all of this knowledge and understanding was really, confined to elites in elite institutions. And now it's incredible that everyday people can have essentially total access to, for instance, on Twitter, conversations that are as good as, and maybe even better than some of the, investment committee conversations at the world's largest hedge fund, and be able to look over the shoulder and learn, and then, get access to the type of work that you do in terms of your macro thinking and risk management. To do it, each one of us has to sort of strike out on our own and get outside of the comfort of the big institution. But I think the world is better off for it. So it's we're you're doing God's work over there. There's no question about that.
Thank you, and likewise, my friend. Yeah, and before we even started, I'll start us off with a quote from our good friend Jackie Robinson, which is, "A life is not important except in the impact that it has on other lives." And I think you certainly, as someone I've seen, try to really extend the high end of the hallowed halls of institutional risk management to the everyday masses. And certainly that's something we core believe in. With our pricing structure, it's very clear that we want our research in the hands of everyday investors. To me, both of us really believe in this mission of, really truly democratizing work, not just creating worser versions of, our flagship stuff that we sell for 2 and 20. No, we're giving away the 2 and 20 to the people who need it the most, which are investors who are obviously out there struggling to retire on time and comfortably by the masses and millions. So you said something that I think we should begin the conversation on in terms of stepping outside of your comfort zone. Let's try to get the market to step outside of its current comfort zone. Obviously, this has been a raging bull market. Not to humble brag, but we've been on the right side of that for our clients throughout the year and really over the past couple of years. What do you believe true? And this could go anywhere, Bob. What do you believe to be true right now that the market currently believes is false? That if the markets suddenly or over time learn to become true, it would have a significant change in asset price valuations and performance?
Well, I think one of the challenges that we're seeing right now is that, let's say, traditional sort of value-based investors are looking at this market and they're saying prices are high, and that is for sure true, and they're high on every measure that you can find imaginable, and that's creating a lot of caution because it always feels, like a tense, let's say, to buy at relatively nearby highs. And then at the same time, when you look at the macro momentum and pressure in the economy, it's, it's full steam ahead. Like already, the economy continues to be pretty strong. And what we're seeing ahead of us is first, this set of easing coming from the Federal Reserve. Despite the fact that the economy is pretty strong. And then on top of it, the most likely outcome, although there's a lot of uncertainty around it from the new administration fiscal policy, is expansionary fiscal policy in one form or another. You put that together, and that's basically juicing an already hot economy and hot market. And that is confusing because you always want to be careful about buying in at the top, so to speak. But the momentum is pretty clear that it's going to extend what is already, these elevated prices.
100%. What is the Fed to do? You said something that struck a chord with me because I've been thinking about this, starting to lose sleep over this, which is we obviously are there's an expansionary fiscal policy coming. Now we can debate the net impact of tariffs and deregulation and tax cuts and likely income subsidies as well. But generally speaking, I think we can all agree as investors that the net impact will be expansionary over time. Certainly as we look forward, 1 to 2 years. With that being the case, what's the sort of Nash equilibrium sort of decision that the Fed should make to cause the least amount of problems in asset markets? Is it a contractionary monetary policy, or should they also supplement that with an expansionary monetary policy, understanding that they may have to be the lender of last resort to the Treasury market, which obviously continues to grow in an unfettered manner?
Yeah, yeah. I mean, I think from the Fed's perspective, what Chairman Powell said earlier this week, I think was very telling, which is they can't start to think about and have policy influence what their monetary decisions are until actual policy gets established. And so that's a very interesting point, because if you and probably not just actual fiscal policy gets established, but on top of it, that it starts to actually impact macroeconomic dynamics. And so sitting in the Fed shoes, I think there's always this challenge, like what should the Fed do versus what are they going to do? And as a macro investor, what you think they should do is like find fodder on Twitter, but it's not how you should trade markets. Like you have to understand what they are going to do, what their reaction function is. And I think it's really important to see on September 18th at that Fed meeting, Chairman Powell rewrote the reaction function, and that was very important. And the reaction function changed from being conservative and cautious about easing, given the inflationary problems, to saying, hey, look, I don't care that the economy is still pretty strong and inflation is above my mandate. What I care about is that, that I'm going to ease and the direction of travel of rates is clear. And so I think the challenge here is we're in this like 12-month time frame where the Fed is basically committed to an easing cycle, even though they probably know, as you said, like who knows exactly the shape, but it's probably going to be expansionary fiscal policy. They're not going to consider it. They're not even going to think about it from a decision-making perspective until they actually see the policy and actually see it affect things. And that's not going to be till 25 or 26, until late 25 or 26. And so my guess is we're going to have a two-tier thing. A bunch of easing that supports an already strong economy, and then on top of it, we're going to get a expansionary fiscal policy that would even further juice the economy here.
Yeah, that's sort of the take. We very much agree with a lot of what you just said. Colin, if you go slide 84 on the screen where we show the Fed's dot plot and along with various other market rates to sort of ascertain what's being priced in across the next few years. And I mean, obviously the September dot plot's a stale based on reading the tea leaves from Powell's most recent comments. But we also have to understand that the September dot plot, they're not going to jump condition from the September dot plot to a dot plot that is significantly more hawkish. It's going to take time for them to ultimately assess the impact of what markets are pricing in from a fiscal policy perspective on the actual economy. And to your point, Bob, that could come as late as the second half of the year in terms of reported data terms, or as late as even the first half of 2026. Who knows how long it's going to take to iron out these policies. I think the selection of John Thune as the Senate Majority Leader is a sort of cautionary tale to President Trump to say, hey, you're trying to add $7.5 trillion of fiscal goodies to the public sector balance sheet, but you're probably not going to be able to get that. So it's like being a kid in the line at a store. You put a bunch of stuff in the cart. I want this toy, I want that candy bar, and eventually you get up there and your mom's like, nope, not that, not that, not that. So we're going to go through that process. And what I'm ultimately trying to say is that the process for getting the expansionary fiscal policy might take time, but the mere fact that it's going to come suggests that the Fed could be, over the next 6 to 9 months, making a critical policy error, much like what they did in the second half of 2020. Again, the Fed is essentially guiding to based on the median longer run estimate of the dot plot, back on slide 84 here, Colin, it's 3%. Now, right. You've talked about this ad nauseum, and I completely share your views. 3% is not the neutral rate, certainly not for this particular business cycle. It may be over a very long period of time, but it's certainly not the neutral rate for this business cycle, as evidenced by the persistent above trend GDP, above trend inflation. What are your thoughts on the development of a policy mistake, and how long then, if you agree that the Fed is en route to making a policy make, how long will it take asset markets to do something about that in negative adverse price reaction terms?
Well, I think we already saw a little bit of the markets pricing in the over easy monetary policy shift that happened in September. You saw bond yields move, interest rates fall on the short end in terms of a 50 basis point cut, and long rates rose in response to that. And I think that's indicative of the fact that that the markets were perceiving that the Fed was too aggressive. Now, how that could easily run further, because when you're in an environment, interest rates today, what are they for? 440 give or take. That's still not that high, considering the strength that we have in the underlying economy and the persistence of moderate inflationary pressures that are only going to likely get further exacerbated by this easing once it flows through to the real economy. And so I think that the challenge when it comes to Fed policymaking is that they've basically committed to a path. Now, they probably aren't going to do the December 25 SEP number of 3.4%, given the underlying economic conditions. But the direction of travel of rates is pretty clear in terms of what Chairman Powell has said over and over again. And so what's going to change their mind? I think what's going to change their mind is that they're going to have to start to see meaningful inflationary pressures build again. But they've already, if you just listen to the rhetoric of Chairman Powell, everything that could be an inflationary concern, he is dismissing, like almost to the point of it's like bizarre. Yeah. Where 6 months ago, he'd talk about Supercore as if it was a meaningful consideration. And now if you bring up Supercore in the presser, he's like, no, that's stupid. I want nothing to do with that. I don't even care about it. I haven't even thought about it. Why would you even bring that up? Right. And you look at that and you say that is a bizarre shift in terms of the policymaking inputs into his decision making. But I think what it highlights is the threshold of evidence that we have a reacceleration of inflation in the economy that's necessary for them to change their mind is extremely high, because they will spend a long time, probably 9 months or a year, of explaining away inflation data that's too high before they finally are going to recognize what's going on.
Well, they're already doing it, right? What did he say yesterday? Somewhat bumpy.
Somewhat bumpy.
That's code. That is code word for we know inflation's going to go up, and we're not going to do anything about it.
And we're not going to do anything. Right. Exactly.
100%, man. And we've, Colin, if you throw slide 26 on, one of the, so we've maintained this resilient U.S. economy theme. We've since September of 2022. You and I talked about it last time we were on our program, and one of the contributing pillars that we picked up since then, that's contributing to the resiliency of the economy, is the fact that you have an expansionary monetary policy for God knows what reason, aside from the fact that the Fed believes that they do not need to see any further cooling in the labor market to achieve 2% inflation. Now, you and I both know that to be a highly inaccurate statement, or at least a very highly likely to be inaccurate statement. However, this is the Fed's perception. And, I want to peel back the onion on why do you think this is their perception? Because, you and I have both met with the Fed on several occasions, all throughout the years. And there are a lot of really smart people in that building, down in New York and down in Eckes building in DC and obviously the Boston Fed. Why do they believe this? Like, what is their fundamental underlying core belief system that is causing them to look through super core inflation in the threes, or housing inflation in the fives, or very clearly an inflationary impulse that's being shocked through markets that ultimately filter into the economy?
Well, I think it's a difference between the academics' interpretation of markets and models and the practitioner's interpretation, and that's really what it comes down to. I mean, the language around very restrictive, I think, is a great indication of how divergent, let's say, a practitioner's view is from what the the board analysts are telling the Fed, and the reason why that is because the Fed will say, hey, look, if I look at short-term real rates, or I look at the current level of interest rates, it looks very restrictive because it's high relative to some other measures. And then the practitioner looks at it, it's like stocks are at all-time highs, spreads are at all-time lows, the unemployment rate is very low by any reasonable standard, growth is above potential and has been for 2 years, GDP gap is at the highest it's been in 25 years. You're like, that does not look restrictive to me. Measure it by its way, not by its theory. And so I think that's the core divergence. I think other people will have more conspiracy oriented views of why they're interpreting things as very restrictive, or have a dovish tilt right now. I would not underweigh the lack of pragmatism in terms of thinking about what's going on here. Remember, Chairman Powell said when they started the hiking cycle, when interest rates were at 2%, he said they were restrictive. Like, just think about how confused that way of thinking is relative to what's actually going on.
No, 100%, man. It's very clearly unrestrictive. You go back to you cited a lot of things in the financial markets and the economy that very clearly indicate that the Fed has, in our opinion, has never really truly achieved a restrictive policy rate in this particular business cycle. One of the things we look at is on slide 40 here, Colin, we show the spread between the 12-month T-bill yield and the baseline Taylor Roll estimate for the United States. And we use the 12-month T-bill yield as a proxy for, the influence of forward guidance on the policy rate, right? Because that's obviously a big feature in asset markets now and in the economy. At no point in this tightening cycle did they achieve a positive value. And that's very consistent with what we saw throughout the 70s, where at no point did they positive value up until Volcker had the cojones, for lack of a better word, to actually achieve a actually restrictive level that's being observed in financial markets and being observed relative to the data. So it's very clear that they're not listening to our friend John Taylor over at Stanford. It's very clear they're not listening to the Yaleys or the Harvard folks here in this podcast. What I keep wanting to pull on this thread. Like, what in the world can they possibly be looking at to arrive at the conclusion that A, the economy, the policy rate was restrictive to begin with, and B, they need to get it down closer to 3, maybe 3.5%, 4% in order for it to be in a quote unquote more neutral setting? I really can't. I'm scratching my head here.
Yeah, well, I think part of what's happening is that they're a bit confused by the labor market, some of the labor market internals, where I think one of the questions is basically like, what is a tight labor market? And if you go back to 2022 and early in the first half of 2023, like, we had a labor market that was the hottest labor market that anyone alive had ever seen. Totally. Like, it was that hot. And so the Fed, I think, in many ways is benchmarking off of that benchmark and saying, well, look, we've, the unemployment rate has risen, 0.7%. And as a result, that means that things must be restrictive. Whereas what really basically happened was, there was no hiring in COVID. There's a lot of layoffs in COVID. Then people struggled to find employees. Then they hired like all get out, and because they were fearful that they weren't going to be able to get access to employees anymore. And then kind of have like taken a little bit of a pause as essentially the growth of their companies is like catching up with their employee count. And in the same way, we've seen in a lot of ways like bullwhips in manufacturing where demand was up and then down and up that are confusing on the, they're confusing if they were just sort of looked at independently. I think we're basically seeing a bullwhip in labor where we had very hot and then some moderation, and now we're kind of like normalizing at a very high level. But if you look at if you narrow in on just the change looks like some deterioration, even though the levels of labor market conditions in any context are very tight.
100%, man. A lot to unpack there, but you're the first person I've heard use the bullwhip sort of framework to describe what's happening in the labor market, and it's one that resonates with me because we certainly, if you look at the data, and this is why I kind of make fun of the finance Twitter sort of macro cabal, if you will, that they get paid to generate clicks and newsletter subscriptions on freaking people out about the macro, and what hopefully what we're doing here at 42 Macro and what you guys are doing at Unlimited is really trying to peel back the onion and educate people to help them make more informed decisions. And most of the time, informed decision is staying invested in the market, and that you're not going to hear that on most macro platforms. But anyway, I digress. One of my favorite statistics, and I know it's one of your favorite statistics as well, because it's a no-brainer statistic to analyze on a monthly frequency, is the nominal employee compensation statistic we get from the BEA. Obviously, every labor market statistic has its own, pitfalls and challenges, but to me, this is the broadest measure of income, nominal income growth we are getting from the labor market on a monthly frequency. And with data through September, and this data tracks our private sector labor income growth rate pretty tightly. With data through September, we are still growing at an above trend 5.5% on a 3-month annualized basis. We're growing at a 6.4% on a year-over-year basis, which is hundreds of basis points above trend. And by the way, we've been above trend on a year-over-year basis every single month since early 2021. At no point in time, if this was all you looked at from a labor market standpoint, in fact, I would argue it's all most people should have looked at because they would have saw the resiliency of the economy coming. At no point in time were we ever able to conclude that the labor market was on very shaky foundation just based on this statistic alone, right? If you start layering on, this survey or this 2-week-old time series from this AI provider or this, worker, you can paint a very credible picture of a lot of stuff in the economy if you want. Certainly an economy as big and data rich as the US economy is. But, I think it always goes back to first principles. And one of the first principles you sort of talked about, which is this concept of employers hoarding onto labor as a function of, this fear that they may not be able to, rehire and retrain talent, kind of in an expansion. And we can certainly see that phenomenon as well. If you look at slide 30 here, where we sort of, show various indications of labor hoarding. So if you look at the JOLTS total job openings, the total employed worker survey, that ratio has declined to a below trend level. You look at the private sector hires rate, that ratio has declined to a below trend level. You look at the private sector quits rate, that ratio has declined, or so that statistic has declined to a below trend level. And each of these statistics has historically been inversely correlated to the private sector layoffs and discharges rate, which I would argue partially because of hurricanes finally ticked up in September, but is still at a below trend level. Like these things are now below trend. You would expect this thing to be above trend. You're also seeing a massive divergence between job openings and total employment, which for the first time ever, we've seen that in the time series. So to me, I think it's very clear that there is labor hoarding going on in the economy. It's also very clear when you're analyzing the data in rate of change format that it's very clear that we are having a robust above trend level of income growth in the economy. And you've been all over the income driven business cycle. In fact, I got that idea from you maybe a year and a half ago. Talk to me about why the Fed is missing this. What could they be looking at to sort of, why are they so freaked out about this? And just, and I think of it like an investor. Why are they so afraid of letting their winners run?
Right. Well, I think, if you look back through typical employment cycles, they're often self-reinforcing, meaning that when you see a slowing of, demand for labor, that creates a slowing of incomes, a slowing of spending, and therefore a slowing of profits, and it becomes self-reinforcing through the employment channel. I think the challenge, what we're seeing right now is, and I should say, and often you can get early reads on that dynamic by looking at what I'd call sort of upstream labor indications. So something like, openings is an indication, is sort of an upstream labor indicator. But right now, what we've seen is because we've gotten this bullwhip effect, you saw essentially really extreme upstream measures, and you actually see it in these charts, like just how elevated things like openings versus unemployed were, or the hiring rate or the quits rate. And hiring rate and the quits rate are essentially the same thing, because most people don't quit their job till they get another job. So those two things are like literally the same, the same type of dynamic. So it's super extreme. And then now it's below trend. But if you were to accumulate that number, it actually over time, accumulate that rate over time, it's actually still way above trend on a level basis. And that's totally consistent with the fact that if you go and look at, something like a prime age a working share right now is at essentially 25-year highs, give or take, with some wiggles. That's the indication, the level of the labor market. That is the level of the labor market, right? The level of the labor market is not the sort of second order upstream, maybe some indication. The total employment's, gives you a sense. And then as you highlight, the income growth is so important. Like if nominal income growth of households in the US, wages and salaries, this isn't even just fake income growth like benefits. This is like cash in people's pockets. If that is growing at 7% a year, there is just no way we are close to recession in an environment where, inflation, even inflation at 3% is fine, with income growth at 7%.
100,000%, man. I might as well say a billion million, because there's no. I'm so glad that it. Sometimes what we do as sort of the adults in the room when it comes to macro, and I don't mince words about that, if anyone's offended. Sometimes what we do is boring. We sort of have to just remind people that, hey, wages and salaries are growing 7% nominally. Stop talking about the labor market. Pivot your focus budget somewhere else. Right, like that's part of my job as an institutional macro risk manager. So I'm grateful to have you on the program always, Bob, because you allow me to embellish the boring parts of what we do. Right,
This is the exciting stuff, Darius. Yeah. What are you talking about?
You mean analyzing a time series is and not just coming up with fancy narratives.
That's what I love to do. Points. It's kind of a joke, but if you're a real macro nerd, like this is the stuff that gets you out of bed in the morning.
100%, man, 100%. And you're right. No, honestly, if you're a real macro nerd, this is stuff that keeps you up at night.
Thinking about it all the time.
I got a note in my notepad, and I'm just like, all right, I gotta chart that. Just call it charts. All right, gotta chart that. Gotta chart that. Yeah. So a couple more things on labor market before we pivot. I would say going back to this bullwhip phenomenon in the labor market, this is the kind of thing, and in my opinion, and I'd love to hear your thoughts on this, which is, I think this could extend itself. I mean, if you look at the level of the employment to population ratio or the labor force participation rate, pick your poison in terms of, what's the available supply of labor as a proxy for the available supply of labor, we're at a level in the labor force participation rate that you got to go back to the, early to mid 70s when women were joining the workforce in masses. We have a labor supply problem here in the United States, particularly in the context of an economy that has a manufacturing boom based on infrastructure investment and the build out of American first manufacturing policies. We obviously have a boom in AI infrastructure development and the heating and the cooling associated with that. And we also have what is likely to be another round of several $1 trillion with the fiscal largesse that's just going to find its way into inflating demand in the economy. How in the world is this not going to wind up with a significant amount of inflation if we tighten immigration policy?
Yeah, I think it's a good point, and I think it is sort of the cruxy question that that's going on. And I think in some ways it's going to be confusing actually in the data. And I think people who have looked at sort of the monthly job numbers have gotten confused in the last 6 months or so. Because remember, in the last 6 months, it has reflected the shift in administration policy towards immigration, where we're not quite at sort of pre-COVID levels of encounters at the southwest border, but they've come down like 80%. And so the flow, the incremental flow of immigration has come down. And as a result, what had been very elevated hiring because there was a good, very, substantial amount of labor supply into a hot economy has fallen. And remember, like the native born prime age workforce growth in the United States is give or take 500,000 a year. Okay, well, if it's 500,000 a year, your employment report, at 100,000 a month is set to tighten economic conditions unless you're pulling people out of, pulling people into the labor force. And I think that's a really just important thing to keep in your mind, which is today a current labor market where there is essentially zero immigration or very low immigration, and where there's a lot of retirees due to demographic issues. It's just so totally different. Neutral unemployment today is totally different from what it was 10 years ago, 20 years ago, et cetera. And so you just have to reframe those numbers. You see an ADP number that comes out at 233. I look at that and I go, how are we going to find, 2.5 million jobs, 2.5 million employees a year on a forward-looking basis? That's the run rate. I don't. Where would you find them? They don't exist, right? And if they don't exist, that will create pressure on wages, and that will create pressure for those nominal incomes to continue to grow.
100%, my friend. And I think the only saving grace from this is, you have productivity dynamics stay robust. Right now we are currently tracking well above trend in terms of productivity. And we've had a thesis for a better part of a year now, really since last November, that this sort of, because the labor, hear me out, the private sector quits rate is declining significantly, substantially from its very elevated level over the past couple of years. And so I think this is sort of the other side of the bullwhip effect that you highlighted in the labor market, whereas folks are now sticking around their current employers for longer periods of time. And anyone who's run a business, Bob, you run a business, I run a business, anyone who's run a business knows that employee on day one is a lot less productive than employee on day 356. Right. And so
that's for sure.
And so on and so forth. And so what I think could potentially be contributing to, maybe not necessarily causal, but certainly contributing to this productivity, I wouldn't say boom, but certainly above trend productivity growth that we have now, that is depressing the inflationary impact of elevated wages and income growth, is something that could potentially persist. I think work from home is certainly contributing to that as well. It's a lot easier to stay employed at the same employer when you can literally live wherever you want and come and go as you want. So I think that's a new feature of the labor market that I think will be studied in future years. But we also have, we're starting to see the more rollout of AI and productivity enhancement tools. Now, I think that's obviously very concentrated to white collar industries that can actually take that information and do something with it. But I got to believe, let's just say, let me put it like this. There are several tens of trillions of dollars of market cap, if not over $100 trillion of market cap associated with AI creating a more productive economy. If that does not come to fruition, we're going to have some version of a mild hyperinflation as a function of these labor market dynamics, on top of the fiscal dynamics, on top of the fact that the Fed has an asymmetrically dovish reaction function. So as investors, we all better be rooting for ourselves to get replaced by the AI and robots at some point in the near future, because this won't end well from a bond market perspective if it doesn't.
Yeah, I think that's right. And in some ways, the productivity that we're seeing is, necessity being the mother of all invention, right? If you can't find the employees that you need, then, and demand is there, at some level, you've got to just create the productivity in one form or another. And so that sort of pull productivity is, in general, a good thing from a longer term growth perspective, because pull productivity almost always gets accumulated in employee wages, right? Because it accrues to the employees who are, who are the only ones on the front line there in terms of what's going on. And so I think it's an important reason why we have this nominal compensation growth that is as strong as it is because employees are accruing that productivity enhancement to themselves. Now, part of it's also going to the businesses, and we have a modest rise. We've had a modest rise in margins as well. But if the whole pie is growing at 6 or 7% a year nominally, employees can get 7% nominal wage growth, and it's not going to be destructive to businesses. The question is essentially, can we get enough? If nominal demand is that strong and labor supply is as weak as we're describing, can we get enough productivity to help offset what would otherwise be that rise in prices? And that's going to be tough. I mean, the current productivity numbers are about as strong as you're going to get on a sustained basis if you look back through time. So you got to hope for a real miracle here, and strong productivity, sure. Miracle, I'm not sure. I'm not sure that that's going to happen.
Yeah, I'll tell you right now. I know our friend Seth Klarman, talks about investing with a margin of safety. If your investment thesis involves hoping for miracles, I'll just say that's probably not the margin of safety you're looking for.
Right.
Absolutely. Right. And so I wanted to conclude our chat on macro before we pivot on the lack of margin of safety that is currently in the bond market. Because I think the bond market is sort of the apex of where a lot of these, sort of economic cross currents will sort of that it is the apex of all these economic cross currents because we're talking about an economy that is structurally nominally hotter than the economy that we've been used to for the past, certainly from the post-crisis era. But I would argue we probably have to go back to the mid to late 90s or even maybe the 80s to get used to an economy that is this structurally nominally hotter. And we certainly don't have a bond market that's priced like that. If you look at where 10-year yields are currently, they're 441 basis points. 10-year tips break-even inflation is 234 basis points. We have a negatively sloped 3-month 10-year Treasury yield curve at it's almost uninverted, but at -9 basis points. And so I did a thought exercise with this chart to say, okay, what if we had a normally functioning bond market? And we just added back the deviation from the long-run mean of 10-year term premia to the 10-year. What would the bond market be signaling if we didn't have all the distortions that have been caused by the growth of the Fed's balance sheet, the Fed's asymmetrically dovish reaction function in terms of their forward rate signaling, and so on and so forth? And we're talking about a 10-year that's priced at 5.67%. And if you had a 10-year nominal that's 5.67%, same level of real interest rates, you're talking about a 10-year tips break-even inflation rate of 3.58%. Which I would argue is a lot closer to what I think the equilibrium inflation rate is in the economy. You and I talked about this in our last chat. And then finally, you're talking about a positively sloped 3-month 10-year Treasury yield curve. So the bond market, removing the influence of the Fed's balance sheet and its asymmetrically dovish forward guidance, is appropriately pricing in a lot of the dynamics that you and I are talking about. How do we get from today's starting point to what I would assume to be this future without causing significant problems in asset markets? And obviously the answer is the Fed's got to be the lender of last resort. But I would argue, and this is the sort of principal question I'm trying to ask, which is, can they be the lender of last resort from this level of crisis, this level of robustness in the economy? Or will they have to create an accident for them to be able to have political air cover to pull out a broom, a dustpan, and a mop?
Yeah. Well, I think part of the story, and you had it in that chart of the Taylor rule, is the lender of last resort, or maybe I'd say the preferred lender in the U.S. economy right now, to the U.S. bond market, is actually foreigners. And the reason why foreigners are such an important driver of bond demand is because everywhere in the world is easing. And we don't, I think probably that doesn't get enough conversation. Like, we right now, just for context, have the last time we had this many countries easing was in the very acute moment in COVID, which is not that relevant. And then before that was September 2008. And like let's be honest, like if you live through September 2008, like today is like not close. Like so far from what September 2008 felt like, and yet we're getting essentially a monetary impulse, a global monetary impulse, which is on par with that time. That is crazy in terms of thinking about how much easing is happening. And functionally, what's happening is a lot of that liquidity that's getting created in the rest of the world is actually flowing into the US bond market, depressing US yields relative to what they'd be if, as you say, if they sort of traded with a normal risk premium. Now, that can get resolved one of two ways. One of the ways it can get resolved is by the economy running hot and eventually dragging up the bond yield because the economy is so hot. I think that's probably the most likely way it happens. Another way that this can happen is eventually there's a buyer strike, in the rest of the world because they don't think that there's good value in treasuries. That seems less likely given what's going on with monetary policy conditions. And so my guess is what we're going to see is we're going to see increasing divergence between US yields and the rest of the world on the long end. But that's going to keep the US a lid on US yields, which is going to flow back into strengthen the domestic economy and over easy essentially long end in addition to short end, which then is supportive to hard assets like gold and stocks at the expense of bonds.
Oh yeah, 100%, man. You and I could go for hours and hours on this. Actually, we just wrote a piece on this exact dynamic today about the mild negative inflection in global liquidity as a function of the strength in the dollar. To me, I think the Fed has a very sort of high wire tightrope act. Do you remember those like old school tightrope people that would like walk across two buildings on a string? And if they fail, they die, like plummet like 30 stories to their death. That's sort of how I feel the Fed is right now, because on one hand, they can't outright monetize the U.S. debt. One, it's illegal. And two, I think if they signaled that, they'd actually cause their own problem. They'd exacerbate their own problem, which is to reduce the amount of volatility in the bond market. Number two, if they're too hawkish, then they obviously would cause their own problem as well. We saw that last summer. We obviously saw that in several other occasions as well globally. The UK, most recent example. So the key takeaway here is I really don't know what the Fed is going to do, what path they're likely to choose to do. But I think it's pretty clear that the path has to involve, and you may disagree, and if you disagree, I would love for you to unpack it. It's pretty clear to me that the path has to involve doing whatever the bond market needs it to do, as opposed to what I think the Fed would prefer to do, which is set policy and allows the bond market to just adjust. I think we've fully transitioned into a world of fiscal dominance, as evidenced by their delayed their reaction to the regional banking crisis amid elevated inflation, their reaction to elevated inflation when they pivoted, when they stopped hiking interest rates at a non-restrictive level, and then obviously the 50 basis point rate cut and dovish forward guided signaling that we have currently, despite very clear indications of a robust economy. To me, I think we've pivoted into a fiscal dominance regime. I think it's increasingly clear to the average investor, but what is not increasingly clear is the path and the sequence of choices the Fed will be forced to make along that path that will ultimately determine the results investors feel in their portfolios. And I can assure you it's probably not going to be linear, because we don't have investors, we don't have pragmatists at the Fed that are viewing the risk in the same way that you and I are doing, Bob.
Yeah, I think if you just take a step back, the basic circumstance we have is we have a pretty strong economy and we've got this monetary and fiscal easing. I think, to sort of summarize, like that sort of circumstance is not usual. Like usually when the economy's hot, you have tightening conditions, not easing conditions to offset the strength of the economy. But, so what? That's the circumstance we're in, imprudent or not, from either the fiscal or the monetary side. And if you look back through time, this sort of dynamic, it plays out in a way that's, pretty straightforward, which is that money flows to pro-growth assets, it flows to hard assets, it flows away from essentially soft money assets like bonds, and that strength in the economy and over easing of monetary and fiscal policy basically is priced in with stronger and stronger growth conditions. And I think that's basically where we're at. The thing that's confusing about it is it's happening at a time when prices are already very elevated. Nominal prices are elevated in the economy. And the key thing to keep in mind there is that the momentum is very strong along this dimension, which, I'm not saying you should ignore valuations, but, you could easily get caught off sides here being underweight financial assets given the strength of this momentum. There will be a day where there is a tightening, whether it's on the long end, whether it's a buyer strike on the long end, whether the Fed finally says inflation's too high, whether fiscal contraction becomes the policy of the day, the way it was like right after the financial crisis or back in the 90s. Like any of those things could happen, but until there's tightening, the momentum of macroeconomic conditions is relatively clear here, and the assets that it favors, stocks and gold and other hard assets relative to bonds, is also pretty clear. And that's you can't fight the policy that you have. You've got to trade and invest consistent with what it is rather than what you might think it should be.
100%, man. That was a clinic, brother. I appreciate you. And before we pivot to some of the things you got going on in Unlimited right now, I just want to hammer home the point that Bob just made, because we are a firm believers of being pragmatists. And one of the recent pivots that we made in our systematic case portfolio construction process was to replace our core fixed income exposure with gold, with the assumed understanding that if we are right on these structural dynamics persisting for an extended period of time, at the bare minimum, it's very unlikely that bonds outperform other assets on a real risk-adjusted basis. If we're right on our beliefs, or some portion of our beliefs, because no one's ever 100% right, so we certainly aren't ever. If we're right on a portion of our fundamental beliefs, it's very likely that gold, Bitcoin, stocks, these types of real estate, these types of assets that have historically proven to be monetary debasement hedges, which I believe will be a instrument that the Fed and other regulators use. Monetary debasement and financial repression will be instruments that they use to deal with this problem of essentially what is going to be too much sovereign debt and too robust of an economy for anybody to want to buy it. That's essentially the underlying dynamic that we have in financial markets right now. And so as a function of that, as I mentioned, we pivoted completely out of our core fixed income exposure, replaced that with gold. So now our 60-30-10 trend following strategy is 60% stocks, 30% gold, 10% Bitcoin. We're currently max invested. And again, it's just a function of the systematic overlays. So I'll wrap it up there in terms of our macro discussion. I did want to pivot to some of the things you got going on in Unlimited. And I'll start by saying, when I first joined this business back in 2009 at the depths of the financial crisis, the first book I read, purely by happenstance, was Thinking Fast and Slow by Danny Kahneman and Amos Tversky. And boy, is that a fun book to read for the first book you read in this industry, because it essentially tells you that everything that everyone is doing in the industry is some version of wrong. And I don't mean that to be pejorative or to be arrogant. I just mean that they won Nobel Prizes on demonstrating things like the lack of persistency of return excellence or things of that nature. And so a lot of the work that I've watched you perform over the past couple of years has been along those lines. Can you talk to me about some of the work that you published recently and some of the key findings of that work and how it relates to the solutions that you guys are trying to deliver to your investors over at Unlimited?
Yeah, I think having been in this industry for a long time, I think there's sort of two paths that macro investors often take, and investors probably in general, which is let's say the path of arrogance, where people basically say, I am the best and I have all this edge and I'm so much better than everyone else. And that that may persist, and it may persist for a period of time. But often that is the road to ruin. And there are others, usually the people who have been in this business for 40 years, all have basically the same attribute, which is that they are incredibly humble. And almost all of them wrestle with whether they even have the ability to generate alpha themselves, right? Generate alpha at all, or be better than all the other people who are doing great work trying to generate alpha all the time. And so I think it's interesting, having been on the side of running a proprietary book and trying to generate differentiated returns. Over time, I just increasingly realized that outperformance is, more a function of randomness. Outperformance relative to other managers, I should say, is more a function of randomness than it is a function of skill. And I started to, starting a few years ago, started to sort of roll up my sleeves and say, what are the odds that an investor does have persistent outperformance? A hedge fund manager, let's say, has persistent outperformance. Is it, how many managers out there have persistent outperformance? And is that greater than or less than what you'd get if you just had random selection? And the thing that's pretty interesting, particularly when you look at the hedge fund industry, is that the hedge fund industry as a whole generates alpha, no question about it. If you take 20,000 of the smartest minds in the world thinking about finance, they over time generate alpha, which is great. Now, the fees they charge are too high, but their strategies generate alpha. But if you look at their relative performance, all the different relative performance of this manager versus that manager versus that manager, what you find is that there's no outperformance persistence that's beyond random chance. Somebody of course has to outperform, because if you flip a coin 10 times or whatever, so somebody's in the top half, every single time for 10 years, but that could be a function of noise, not a function of their unique skill. Right. And so if you think about that, if you think that outperformance persistence is elusive, and that there's generally alpha in aggregate, actually the best solution, the best portfolios you should be building from an alpha perspective is you should be building well-diversified index portfolios and focusing on reducing fees rather than trying to pick managers. And there's a whole allocator industry, thousands of people focused on allocating to hedge funds. And I will say this in a way that hopefully doesn't piss off too many of your clients, which is it's a total waste of time. It's a total and complete waste of time. You'd be much better off as an allocator. You'd be much better off either randomly selecting, just select 20 random managers. The odds that you're going to do literally the same, or finding solutions that are index solutions. And that's really what we're focused on at Unlimited, is how do we pivot people's attention away from individual manager idiosyncratic selection to instead think about indexation of 2 and 20 strategies, and then getting access to that at a lot lower fees.
Your business, Bob, it's sort of it is pulling on a thread that we've observed, obviously, as institutional finance people, that I think guys like Ken Griffin and Izzy Englander and Steve Cohen have figured out, which is that the persistency of outperformance among individual managers is not great, but they're, as a whole, this group of managers will generate alpha. And so it's my job to, collect the alpha from the ones that generate alpha in any given year and get rid of the ones and keep a robust stream of insights and managers on the platform. You are sort of replicating that for the average investor, while also not pushing them, not destroying the return with very, very elevated fees, as some of our friends over those funds that shall not be named. So talk to me about how you guys are doing that, and sort of what successes and or failures and you guys might have had trying to replicate that strategy.
Yeah. I mean, what we've done, and me and my co-founder Bruce, like between the two of us, we've got it. We hate to say it, almost 50 years of experience doing this stuff. And our thought sort of a few years ago was thinking about how could we take our our experience building these proprietary strategies and use that that insight, that experience, that expertise, and pair it with modern machine learning techniques, things that basically computationally weren't commercially viable even 5 years ago, and build technology that essentially allows us to infer how managers are positioned.
Mhm.
Because if we can infer how managers are positioned, by the different various strategies that they're pursuing, then what we can do is we can take that understanding and translate it into positions and liquid securities, and then package it into different packages that make it available for everyone. And because we're two guys in a Spartan office, as you can see behind me, using technology, we don't have to charge an arm and a leg for it. We're not paying highly paid PMs to generate insights. I like to say we kind of hired 20,000 hedge fund analysts and they don't even know
I love that.
it.
No, look, that's a big development. I mean, I got to imagine that the allocators are going to come kicking and screaming because of their relationships and their connections. And, quite frankly, people just need to retire until the new people replace them with better, fresher ideas. But to me, I got to imagine this is really receptive to the investment advisor community, which has historically been on the outside looking in at the kind of alpha that's being generated by these top multi-manager platform hedge funds. How's the success of the business going?
Yeah, yeah. I mean, I think a lot of if you're a independent advisor, you start with 60/40 or something equivalent to it, and you're like, look, I need to give my clients something better than 60/40. And the solutions out there for them to invest in alternative assets suck. And they suck because they're almost always charging rack rate fees. They're almost always charging a platform fee on top of rack rate fees. They're in almost always in tax inefficient structures and that are illiquid and concentrated. And for many of those advisors, when you talk to them, it's like the paperwork is just like, oh, what a pain. All this paperwork to figure out one particular investment. And so I think a lot of advisors that we talk to find the opportunity to invest in alternative investment strategies and hedge fund style strategies in a liquid, tax efficient wrapper that you can just execute on, and you don't have K1s and you don't have to deal with all that extra stuff. That's a way to bring something, novel, diversifying to their client portfolios without having to do all the work that, investing in a single fund on iCapital would bring. And so I think that's, it's not just the lower fees or the more tax efficiency, it's also the operational efficiency that when we talk to the sort of everyday advisor, that gets, that they find very compelling when they're looking at these sorts of approaches.
Well, I find it very compelling, man. I want to say HFND is your flagship vehicle.
That's right. That's right. Yep.
And where can folks go to find more about what you guys are doing at Unlimited?
Yeah, yeah. At Unlimited, check out unlimitedfunds.com where you'll find our blog with a bunch of this research. Hopefully, if you're an allocator, doesn't piss you off too much. And and also, if you're interested in ongoing macro takes, I know you mentioned it at the top, Darius, but very active on Twitter under Bobby Unlimited and also under my own name on LinkedIn. And I have to say, I just started a TikTok account. So if you're on TikTok,
Oh boy. I better
actually
not see you
inspired.
dancing on TikTok, Bob.
I was inspired by you. I found found your content years ago when you started doing the macro minute, which is never quite a minute, but nonetheless, it's a minute. And I thought it was such a great, it's just you were sitting there like saying, "Hey, look, I'm just going to go through what I'm thinking about the information that I'm seeing in the world today." And so I'm basically doing my version of the same thing on TikTok every morning, breakfast with Bob. So if
Love
you
that.
are on TikTok, or have a Gen Z friend, family member, or colleague, you can recommend it.
Absolutely, man. Well, if you guys sat there through this whole hour-long presentation and you're not wickedly impressed by Bob and what they're building over at Unlimited, shame on you. But for the rest of you guys with some damn sense, go check out Bob and what he's doing at Unlimited. Bob, man, it's a pleasure. Always a pleasure, brother, to connect. Wish you all the best with what you're building. Like I said, at the beginning of the program, I really believe in what you're doing. People say they're democratizing finance because it's a funny thing. It's a nice thing to say if you want retail investor clients. I think you and I are really doing it, man. So I appreciate you. Oh, by the
All
way,
right.
let me sign out. Next week or next month, we got our friend Peter Bookvar joining the program. I actually had the great pleasure of meeting Peter in person at the CNBC's Delivering Alpha Summit this week. So shout out to Peter, awesome dude, wickedly smart guy as well. He's going to have some really awesome insights. So be on the lookout for that in early December. Everyone have a wonderful day. Have a great weekend. Cheers. Awesome.
All righty. There we go.